It's Monday, everybody. Let's go. The AI story over the weekend got a little nuts. It would not be the higher standard without a First Form sponsored energy drink, Form Energy. Shout out to Andy Frizella and the team over there. We love you, and you keep me going. You keep me caffeinated, so I love it. The chat is live if you're on YouTube and X. I got the restream up here, and I can see all of the lovely comments. And there are a pretty good amount of you. What up, Said over there too? And look, we're going to spend some time today talking about a lot of wild stuff in the real estate market. There's definitely some conflicting narratives we are going to correct. There's some bullshit. We're going to call it out. Then we're going to hop on over to some of the stuff we're seeing in AI. We warned about this on the show. And of course, people were like, it's not going to happen for a long time. We're already seeing some of this wild stuff happen right now. And it's going to get worse before it gets better. The AI agent bots having their own social media account is nuts, but we'll get into that. And then we're also going to be testing AI on our show. I got everything up and working. We're now scraping social media platforms like X to bring you the top news of the day as far as mentions and overall just like volume of information goes. And we're going to use that as part of our price prediction model for future scoring and forecasting of what likely stock activity will look like. Again, we are not making stock recommendations, but certainly going to help you have hedge fund style analytics. All of that is going to be fully implemented and beta tested for you guys to take a look at today. We're going to go through the show, but before we do any of that, let's go to the comments. Oh, Saeed. Oh, we got a Rajil in the house. Look at you, Rajil. How you doing, brother? Can pop. Got to do it for my guy. One of us has got to pop some cans over here. Who else we got over here? We got Velocity and Venture. What up? What's going on? How you doing? Let's see. I got my own comments in the chat because, shout out to me, right? Sean, what up, Sean? How you doing, brother? All right. So with no further ado, let's get into the basic place. We like to start in the market status. What does the market look like? Well, this is what it looks like today. We're seeing what looks to be a healthy bull run as the market's open. And keep in mind, we had the FOMC new head and Warsh named on Friday. The market freaked out a little bit, pulled back a little bit. I would say this is not a tech-led run rally. This is the overall market seeming to pick up. And again, for those of you who don't remember, these follow the ETFs, which track the indices. We like the ETFs because they show you more real time, including derivatives and kind of analytical trading. So there's a difference of opinion as to what we like, but we like this. This is a great way to start the market on a good Monday, a healthy bull run, but not all is to be believed. And we're going to spend some time getting into a little bit of what the Fed is going to do or may do that's going to change the dynamic in the market, which may be contributing to this. And of course, Bitcoin could have a massive fallout. We're going to talk a little bit about that too. Let's get into the status of the markets. The silicon, see, my head's in the wrong place. The synthetic valuation index. The market is calm. For those of you who've been tracking this on the show with me, you know that this right here has actually started at about 90 and crept down and crept down and crept down. We saw it about 85, 86 last week, and now we're sitting at 83. The most notable portion of this that's changed since the last time we talked to now is the intraday range stress is now normal. It's not what I would call calm before, so it pivoted from still a healthy point to a healthy point here. I think what you're seeing is you're not seeing the influence of tech stocks dragging the market one way or the other. And this is just normalized trading activity. So we got a nice, calm, healthy bull run to start Monday. That's a good thing. No one should be discouraged by any of that. But the most important part of the influence in the market we're going to talk about today is this, the Liquidity Pulse Index. And we're going to get into a little bit of why this dynamic is changing and the Fed is now doing something interesting. So we before had talked about how the Fed was dumping $60 billion into the bond market on the 10-year, trying to drive the long end of the curve up to try to generate long-term, loans, if you will, to the government, right? And that has changed the liquidity pulse index here dynamically, but we've also seen some stuff the Fed's supposed to be doing. And I'm going to bring up some stuff that was on social media over the weekend, which effectively led to at least some people being concerned that this was likely to get exactly what we're seeing here. So somebody in the market knew something they may not have supposed to have known, I guess. But we have a Fed balance sheet, which is tense. It has actually improved a little bit. A reverse repo and treasury is about the same, but the net liquidity level and liquidity pulse score have worsened, meaning that there's less liquidity in the markets available today, which is going to fly in the face of some of the narrative that we've seen. So I think that's definitely going to be an interesting change there. BLS will not be releasing Friday's job report as scheduled due to a partial government shutdown. And that is one, Saeed brought that up, and I appreciate you, Saeed, in the chat. I would be remiss if I did not acknowledge that this did happen over the weekend. We had a partial government shutdown that took place, I think it was Saturday night at midnight. And you know what? That shouldn't have surprised anybody. That has been kind of par for the course. The political parties, as they may be, will use it to negotiate. This is one in many of a long line of government shutdowns, and the only people that are really impacted in a negative way are the government employees who don't get their paychecks. So this goes on for a prolonged period of time. And as a reminder, the last government shutdown was the longest government shutdown in modern U.S. history, if not ever. And that's a problem. So expect this problem to continue to increase and be fodder for conversations. As of right now, no one's concerned. Usually when people don't get their 2-week paycheck and their 30-day paycheck, that's when people start to really catch headlines on this stuff, and the mainstream media picks it up, and it gets ugly and nasty and all the things. Let's go into housing affordability. We still have a strained market. Shouldn't come as a surprise to anybody. Mortgage rates have not improved. I'm pretty sure this is not updating, so I will follow up on that on upcoming shows. But mortgage rate pressure is still locked out. Interest rates being the biggest pressure on that. Price to income ratio, the home affordability side of things, the actual price of homes is not improving materially, and a big problem. And I've caught some people slipping on social media late, and we're going to talk about this and what that looks like in a meaningful way, because I'll tell you right now, I like Logan from Housing Wire. I'm not talking trash on him, but I will say that he said something this weekend that just pissed me off to no end. It was so materially disconnected because he wanted to win an argument. And I get there's a lot of trolls on social media that say a lot of stupid stuff, and sometimes you just got to prove them out. But you can't be tone deaf, brother. You can't do that. And I'm going to show how one of the comments that he made was materially tone deaf, and I'm going to back it up with stats and data. Again, no disrespect to him. He's not factually wrong, but he's just tone deaf on the ultimate message. And again, supply in the market is healthy, and I frankly expect this to expand over time because people can't afford to buy as we kind of get to normalize interest rates again. Again, anything below 8% on average is still a, quote, good rate relatively. So let's go into some calendar analysis here. Take a look at the calendar. This is this week, February 2nd, 2026. ISM manufacturing PMI, Saeed just told you the government data is going to be delayed that otherwise should come out. We got ISM servicing PMI, JOLTS job openings will probably be delayed as well. Non-farm payroll will also probably be delayed, and unemployment rate on Friday will likely be delayed. But you will still get things like Michigan Consumer Index on Friday as well. So there are some data points that are still coming out, but none of these are going to materially change the landscape as far as I'm concerned. They're probably going to be pretty stable numbers that aren't going to freak anybody out. Now, if you haven't watched the show a whole lot, I'm going to break down some things before we get into some of the juicy, meaty details of what really makes the show fun. Usually me talking some shit. But here's what's going to happen, okay? We get into this information to give you a pulse and idea of the market, so you don't have to watch CNBC for 4 hours to figure out what's going on. We're going to tell you what's going on. Market's calm in a healthy bull market. Liquidity in the Fed system seems to be a little bit at play. And the housing market, well, is still the housing market as we've come to love and hate it for. We're going to spend some time going into the sectors, and then I've got an entire show of data. And let me cover what I'm going to cover. Let me tell you specifically so you know right out the gate. We're going to talk about wages and the idea that wages cause inflation. I don't believe that to be the case. We're going to talk about the wealth divide continuing to get worse with some data. We're going to talk about American spending on eating out versus eating in. You'll be surprised with some of the data there. Corporate profit margins. We're going to talk a little bit about the San Francisco Fed and their house price data. That's going to go us into a whole housing segment. Then we're going to have a little bit of conversation about Bitcoin. I think there's some interesting things there, and I would be remiss if I did not mention that the newly released Epstein documents do talk about this. And then we're going to end with Saeed's favorite portion of the show, a conversation about cryptocurrency and the inverse relationship, if you will, to the Fed and some of the stuff that we're talking about. And we're going to talk about a little bit of what the Fed is likely doing today, which made that Fed liquidity pulse a little bit weaker. Let's jump into sectors, kids. Oh yeah, my favorite. Okay, so this is the housing home builders rate sensitivity demand. So the housing home builders, we look at this particular sector of the market because we want to understand how they're responding to interest rates. Right now, you don't seem to have any drag. They seem to all be up a little bit, kind of normalized a little bit. I would say this is probably just normal movement throughout the day. Again, we are in a bit of a healthy bull market, and because of that, if you're looking at, let's say, this chart here, because we're in a healthy bull market, you're going to start to see stocks kind of gradually increase. Unless you see something that appears to be a statistical outlier in its increase, this is all normal activity in the market, okay, kids? So let's get back to the sectors here. So this is the housing market. Again, interest rates have not moved materially one way or the other. Lennar's down a tiny, tiny bit again, but these are not material deviations. Pulte Group up even 1% is not what I would say concerning. We can look at that if you want to in further detail. PHM. And we can do something here. Let's take a look at PHM real quick. PHM, I'll type that in, jump over the stock here. There's a Pulte Group. So it is trading near intraday highs. So there's probably some stuff there we can dive into. But let's look at PHM from a different perspective. Let's take a look at that from the market outcome forecast model, which some of you guys have not seen us use here. But I'm going to give you guys kind of an early run at what this looks like. And for those of you who said, hey, Chris, this is new, I've never seen this before. That's right. This is going to be new. So this is the outcome forecast model. We're taking a look at all of the data in the markets, and we're letting this algorithmically. Now, this is not AI driven. This is algorithmically driven. And what this does is this is basically looking at the same quantitative data that hedge funds are looking at in order to give you an idea of how to buy and or sell this stock, given its transactional volume in the day and some other factors. Let me break this down to you, okay? So right now you got Pulte Group in the market. It's giving you an overall score of 56, which is there a trade allowed, yes or no? This is saying you can make a cautionary trade here if you elect to do so. It's giving you its current price at $126.71, which is up slightly on the day because we saw that on the previous chart. And we know based on the chart activity that it's trading near intraday highs. See, all these things, they piece together nicely. The instrument, it's telling you if you're going to trade this, you don't buy options, you're going to buy shares and you're going to hold, but you're going to hold for a short-term trade. You're not going to hold in perpetuity. This appears to have some market risk involved in it, i.e. elevated market risk, likely due to some factors that we can talk about down here below. Let's look at this. The macro economy right now is about 19, saying that the macro market is not favorable for a trade in the housing sector. The market in general, as we know from the status, is in a healthy bull run. So you're seeing 83, that's positive. So the macro event looks at upcoming data points that are coming out. We know there's been a government shutdown, so this macro factor is weighing this very heavily negative, giving you an elevated risk score of bad headline press. Meanwhile, the market symbol down here is telling you that the market seems to be pushing up in a healthy bull run. The symbol trading volume here looks at just the trading volume of this symbol through the day. It's creeping into positive. It's putting you in a setup for the trade range. And then the event score is, are there any looming events that are likely to come up on the calendar that are going to impact your trade? And they're saying the setup, some of the stuff we know is going to be delayed now. So I would discount that a little bit and say that's probably a little bit more green. So if you wanted to buy this and write it out for a short-term trade, you probably could do that and probably make some money on it. That is what our outcome forecast model is going to look like. And when I combine it with some of the other stuff that we're going to talk about here, and I'll just give you a sample run of what that looks like. This right here, oops, I probably should refresh that a little bit. Let me try that again. Oh, you know what? That's my bad. Let me activate it. Silly. All right, so this coming up right here is what I like to call our, well, I'm calling it our XAI. Is it loading? It's not loading. What? Let me try this again. There we go. Okay, sorry about that. All right, so this is our XAI, AI-driven analysis of what's going on. So one of the problems that I had was anytime anything hits mainstream media, it's usually been on social media for a prolonged period of time. We wanted to find a way to use AI to scrape social media platforms and give us a real-time look at what the market is likely telling us for any particular topic. Right now, the topics that are being covered in social media: natural gas prices collapse, market rally despite gold concerns, Oracle's massive $25 billion bond offering, right? So these are pretty interesting insights. U.S. and India trade deal, record corporate bond issuance, right? We're gonna get into that in a little bit later. And Disney earnings with mixed results, okay? So let's use Disney as a great example, okay? Disney, as you also see down here, is trading down a little bit because of the mixed results. AI has scraped social media, and it says right here, Disney reported Q1 results with revenue beat, but declining entertainment margins at 7%, stock down 7.21%, despite Parks division strength. The mention score, meaning it's mentioned 160% more than it has been. There's been moderate engagement on this topic on social media. It has caused high volatility in the stock price. The risk level is moderate, and this affects, of course, media and entertainment sectors if it were to drag the sector down. The AI insights, parks carrying Disney while streaming bleeds suggest unsustainable model. Look for activist investor pressure to spin off divisions. That's just all AI. I had no involvement in that. The controversy score here is about a 6 out of 10, which basically tells you how divided or contested the overall opinion of this is down here. This is what's going to help us kind of have some insights here. And what's really fascinating too, if you want to play with this, and we do want to play with it, is we can go back over to the outcome forecast model that we talked about a little bit before. I can hit enter over here and bring this up, and I'll go over to the forecast model, and boom. This also tells me that this is trending now by using that same AI algorithm. So if we ever look up something on the Outcast forecast model, this forecast model, which is using hedge fund type analytics and algorithms, but no AI, this will tell us that the AI is also picking it up as a trending stock that is being talked about on social platforms at any given time. So now you can blend all of that together, real-time market risk, real-time social media risk for the behavioral economics piece, and we can piece this together for an investment narrative. And in case, again, using Disney as an example, as a trade allowed, cautionary, they're saying you're actually better to hold cash than you are to invest in this particular stock, given the volatility. But if you're going to go cash into stock, this would be a trade for you. It would, again, be a short trade with an elevated environment. And it tells you right here at the bottom, if you ever want specific insights, the top drivers based on the day and time, Disney momentum, selling pressure, the market is selling. We know that they had some revenue issues that we just talked about that was pulled up in the AI. Synthetic volatility conditions seem calm, so it's a calm risk market. There doesn't appear to be extra fear in the markets. It's a plus. And liquidity pulse index, liquidity draining, showing the Fed is draining money from the market. So they expect that this will kind of trickle down to the consumer. It'll pull out a little bit of consumer spending, and that means less spending at things that are discretionary spending, i.e. Disney products. And that is our two new models that I was super excited to bring to you. I hope those are interesting. And I'm going to pause for the comments because I just gave you guys a ton without pausing at all for breaks. So what do you think? How's it look, boys, girls? What are we thinking out here? Is it nuts? Is it good? Let's see here. How's the silver stackers feeling today? Not so good, I'm sure, as AI told us in the earlier modeling. Let's see what else we got here on Instagram. Hi, honey, you're out there. I see you, baby. I love you. And for those of you on Instagram, let's see what comments we got here. All right, cool. Lots of comments. Okay, so I'm not going to get to all of them, but suffice it to say, anytime you guys want to see any stock action like that, one of the things we're going to do is we're going to include a market segment moving forward where you guys can comment, and it'll actually change stuff on my end in real time on the back end, and I'll be able to go and look at it and tell you guys straight up what's happening. Meanwhile, let's get back into the sector analysis. I think we should keep going here. Credit conditions appear to be good. The banks are all up. CRE, commercial real estate, market open. We got some refinancing risk because as rates continue to push up slightly, this market continues to be something that people are watching. Again, housing is not necessarily the only risk factor in the economy. People would argue that office space is the biggest impact. American Tower having the most exposure to that. Simon Properties, malls, as you know, and a bunch of different types of commercial real estate in this particular cohort. Mega caps. Let's take a look at those. Apple, Microsoft, NVIDIA, Amazon, Alphabet, all doing pretty well. NVIDIA down largely because of that whole situation that came about with the OpenAI. NVIDIA was supposed to invest about $100 billion in OpenAI. Then there was some fallout between the CEOs there. That's not good. And we see a little bit of price activity there, which I would say is probably normalized. I don't think there's anything here that catches my eye. Dive into consumer spending. This is the consumer health chart. This one is going to be really fascinating. Remember this chart when we talk about something in about 5-10 minutes. This chart's going to come back to be really, really fascinating. Walmart, Target, Costco, Home Depot, Dollar General. This is where people go to spend their money when they feel good. When they don't feel good, this goes down. I mean, it's as simple as how the consumers behave. We know the Fed might be pulling money out of the system. So if that's the case, you would expect there also to see some changes here as well. Jump over to the industrials real quick. No clear sign there. Real estate economy appears to be relatively healthy, as you know. Exxon and energy sector all down today, and I got to figure out why I've been on this too long with you guys. But Disney is probably the star outlier from the social media rhetoric. Capital preservation mode, again, no clear signs. This is where the money goes whenever they want to preserve capital in a market they think is volatile. So if you see something like this synthetic volatility index start to get red, people start freaking out, you start to see money go this way, that means you're going to have people go into protectionary stocks like that particular sector here, which includes old school names that you know, known for generations, frankly. Procter & Gamble, Coca-Cola, Johnson & Johnson, Xterra Energy, Duke Energy. So these are what I would call the staples. Now, You guys ready to get into sexy stuff? Because I'm ready to get into some sexy stuff. I got to tell you. Okay, so before we do that, let's have a little conversation about inflation, right? There has long been kind of a theory, if you will, that wages cause inflation. You pay people more money. As they get more money, they start buying more stuff, supply and demand, prices go up. Not rocket science, okay? Unfortunately, there is a narrative about inflation that I think they call it Keynesian. I'd have to go back and check my old school economics information, but they blame the purchasing power of the consumer, i.e., inflation goes up because consumer wages go up, and because of the purchasing power of the currency, that drives prices up. Except there is one set of circumstances which that is not the driver of inflation. There are other drivers of inflation, and frankly, that's government spending. And government spending, which we know has gotten wildly out of hand. We have a government shutdown right now, okay? You've got this tariff bill that's come in, but you've got a ton of spending on things. And you're going to need to spend as a government if you're going to keep up with this whole AI, cryptocurrency race. The CapEx spend for companies is no different than the CapEx spend for the government. So you're going to wind up in a situation where the government is spending and printing money out of control. And that is also inflationary. Yes, 70% of GDP is consumer spending, but we have a problem with that logic as well. And the logic problem with consumer spending and a K-shaped economy where you have a distribution of wealth which is uneven and a distribution of spending which is uneven, plus with unprecedented government spending and an unprecedented government deficit and government shutdowns, it leads to inflation unlike inflation that we've really experienced before historically. And I'm sure there's some historians out there who would like to argue about times like hyperinflation and other times in the economy. I'm telling you, that ain't the case. And this is why we all feel a little weird, right? If you're not involved in the markets per se on a daily basis. So with no further ado, I think we should spend some time diving into some of the analytics on the social narrative. I'm going to spend a healthy amount of time today on X. I've been trolling a little bit because you know me, I love the troll. One of the things we've done here is we've tried to put as much as our narrative for social stuff on, let me see, this side here, and all of our algorithmic stuff on this side here. So whenever I gave you the XAI breakdown, it was on this side. It's supposed to be a visual cue so that you understand that if it's on this side, it's probably social behavioral economics driven, and on this side, it's probably mathematically algorithmic driven, but again, whatever. All right, so this, according to the Kobesi letter, the wealth divide is spreading to inflation. Okay, we've already heard about the K-shaped economy, right? Where instead of having a middle class, you've got an upper class, and you've got everyone else down there. And because of this, you've got this portion of the wealth divide spending to prop up GDP vis-a-vis their spending. Their spending is enough to outweigh the spending of effectively an entire class. We've covered that on previous shows. You probably know that if you're listening. And frankly, if you're like me and you're poor, you're not up in the uber upper class, you probably know exactly what I'm talking about because you see it all around you in the social media narrative, which is wild to watch, mind you. Good job breaking down the XAI agent. Thank you, Saeed. I got to tell you, it's been fun. Sean, you still with me out there, brother? You still good? Yeah, I see you. Let's see who else we got out here. Christian out there. Yeah. Okay, so we got some people on different platforms. So I get the feed fed in from X, from LinkedIn, from YouTube, and I can't get Instagram there, so I have to kind of bounce back and forth. So if I don't say yo, what's up, it's because not because I don't love you. It's probably because I just didn't see you visually. But let's jump into this real quick and spend some time on it. Okay. All right, so the wealth divide is spreading to inflation. New data from the Fed shows that lower income to U.S. households now faces higher rates of inflation than higher income earners. So think that through. You got a wealth divide, upper class, everyone else, right? And there's no middle class because the middle class can't afford to buy homes anymore, which we're going to spend some time on there too. Now the bottom 40% of U.S. households is seeing an annual inflation rate of about 3.1%. So let's do this. 3.1%. Meanwhile, the middle 40% and top see inflation rates near 2.9%. I really got to work on my writing here. So yeah, so if you are in this lower, you can call it third, but really it's lower, I think, 3/4 of the economy by population density, you are getting hit by inflation harder. Now, this is the overall net aggregate inflation. This isn't even like the real cost of living inflation, which in my mind is closer to 20%, but it is without question proven now, mathematically, statistically, this vis-a-vis the Kobe letter, that the lower class, really everybody else in this economy, is being impacted by inflation worse than the upper class. And because of that, you're seeing a detachment of understanding. I think it just permeates. When you see somebody who's very wealthy going like, it's not that bad. Well, yeah, it's not affecting you as bad, bro. I mean, not only because you make more, but because the price difference that you see, and this is a very simple concept, right? If you're buying really expensive stuff all the time because you can afford it, then that really expensive stuff has less room to move up versus the moderate commodities, which have more room, i.e. eggs, i.e. bacon. How many times have we heard that's gone up 100% in the last couple of years, right? So those main staples that we all need to survive are going up in a meaningful way, and that's a less of a pro rata share for somebody who's wealthy. So why is this happening? Because the lower income households are spending higher percentage of their income on necessities. We covered this also on a previous show where I showed you a very similar looking chart, and I can bring it up again if you guys want to see it, where the necessities were up here, right, and the nice to haves were down here. And this was stuff like TVs and all the services and everything else, but this was your hospital, right, your school, and all the stuff that you needed. Ironically, also everything up here, the necessities, also had government intervention into it, which is kind of an interesting kind of note to draw there. And everything that didn't have pure capitalism plays had a higher cost increase, which is kind of wild when you think about the context here. This includes rent, electricity, food, and transportation, which have far outpaced headline inflation numbers. Inflation remains higher for many U.S. households. And you know I love chart work, so let's get into that here. Here you have lower income households facing higher inflation, the bottom 40%, 40 to 80%, and top 20%. You can see the difference. Now, this isn't aesthetically, like showing a pretty wide divide, but what it is showing you is there is a material and calculated mathematical difference between inflation at the top and inflation at the bottom. This still divides it into thirds. I don't think that's appropriate anymore because I think that the nexus, and let me show you exactly what I mean by that. If you look here, and let me see if I can do the thing that I've always tried to do and never could do well. Here you go. There we go. Look at that. You look there, okay? What's happening here is fascinating, is that the divide in how this impacts people is changing. And that divide here, let me go back here. That divide here, if you look in and you zoom real close, the gap at the top is slightly wider than the gap at the bottom. And the reason why is this middle class right there, that bottom 40 and middle 40 to 80 are much, much, much closer in proximity than the top 20% is to anything else. So I think what you're getting is these two classes of people being smashed together in large part because the inability to buy homes and because the overall net cost of inflation is impacting everybody down there a whole lot more. So you're seeing this gap get less and less benefit and this gap getting all the benefit, and that's becoming a very big problem. Again, not saying that there's not other things to talk about here, but certainly that's a dialogue that needs to be unpacked and dove into at some point in time. So as we go through the social media aspect here, there's another part of this that I think is worthwhile to talk about. American spending on eating and drinking out. Here it is. People get angry at this point, but aggregate American spending on eating and drinking out or having food that is delivered is at a record high. Okay, pause. Food being delivered is a relatively new thing. So for it to be at a record high shouldn't concern anybody a whole great deal. Now, having food that's eating out and drinking out is at a record high, and a proportionate spend on store-bought food is at a joint record low with peak housing era bubble. This is the kind of shit that pisses me off to no end, okay? What this guy, Mike Bird, is saying, and again, this is statistically, I'm not disrespecting him, but I'm just saying, like, it's tone deaf. It's just fucking tone deaf, okay? Yes, people are eating out at an all-time high. I'm gonna bring the chart up so we can look at it while I'm doing this, but yeah, we're getting food deliveries at an all-time high. You want to know why, my guy? Because eating out, now that inflation has hit things like eggs and bacon and your basic buying from the grocery store staples, and because you've seen eating out costs relatively come back down over the course of the last 20 years, is almost as expensive as buying from the grocery store. My wife and I do this all the time. We'll buy a nice cut of meat, we'll cook it at home, we look at the overall expenses of the meal that we made, and guess what? It's almost, if not more expensive than it is to eat out at some restaurants for effectively the exact same quality because we're not getting the benefit of wholesale purchase pricing where they are, so they can pass along their wholesale plus their service costs to us as a third-party outside food supplier, somebody who makes food, a restaurant, to me, and it's going to cost me almost as damn much as it is to buy it from the grocery store. So yes, people are eating out just as much. Not because they're not financially concerned, but because this guy's ignoring that the price of basic staples of food have gone up and eating out has gotten a little bit cheaper, that incrementally you wind up in a set of circumstances where the price delta isn't that big. So most American consumers are going, well, why eat at home? I'm not saving any money anymore, you know? And that's where you're going to see a lot of this tone deaf language come up, where people like this guy, who I'm sure is a very intelligent, smart man, come and say really, really tone deaf things because all they want to do is defend an argument about about economics that sits in their confirmation bias, and it's just bizarre. It's absolutely strangely bizarre. And I got to tell you, let's look at another one. Okay, this is going to blow you away. For those of you who watch the show and you know, I've been saying this and kind of preaching the choir for a prolonged period of time. Corporate profit margins sit at 16%. That is the highest level in modern history. Okay, corporate profit margin, i.e., corporate profits, the money they make after expenses, the money they are making at 16%. Is in fact at an all-time high. Shouldn't wages be close to that? I'm pausing for emphasis. Let that resonate a little bit. Shouldn't wages be there? And again, I know that everybody in corporate America is like, Chris, you just came from that world. You know, companies don't work that way. Yeah, I get it. Okay, but if you got the stock market at an all-time high, housing market at an all-time high, gold and precious metals surging, you've got AI and all this revolution coming down the pike. What point do we care about humanity here, right? And here you go. There's your corporate profits. I mean, that's a pretty easy chart to read. I don't even care if you're on, on the vertical platform. This bad boy is pretty legible. You can tell it's going the right way. For those of you who don't see these charts a lot, these vertical gray bars are recessionary economies, and everything else in between goes to show you the corporate profits. And this is what I mean when I say on previous shows that you've had 14, 16-ish years of artificial interest rate deflation. We've had one of the longest prosperous times in modern American history. This is indicative of it. Okay, this is what it looks like, kids, okay? You go from down here all the way up that way. And yes, you've got peaks and valleys in between, but when you average it out, that's the line. You've got unparalleled profit, prosperity in the economy. Everybody feels like they're a rock star. Like everybody feels like they're going to make money. And this is what happens. You've got all-time corporate profits. And some of that should be coming down to the American populace, but it's not. It's going down to the wealthiest of Americans, those who own companies, those who own businesses, which is part of the reason why we always suggest on the show, you need to own your own business between the hours of 5 p.m. to 9 a.m. because this is clearly where the wealth is going. And that's where the money you got to follow is. So the market is kicking butt and taking names. And this is the problem, right? Now, is that money being distributed back to you, me, the consumer? No. A large part of this is being redeployed as capital expenditures. So we're seeing dividends actually at a relative low comparative to historical numbers. So if companies are making 16% is the highest profit level in history, modern history for companies, and they're building out these massive infrastructures, this huge CapEx spend, the macro 30,000 foot elevation is they're going to stop paying dividends to shareholders because they have to put this money into becoming more efficient. It sounds simple. But when you take a step back and you look at the overall economics of this, you guys are more profitable than ever, dumping a majority of your all-time high profits into CapEx to become more efficient, to be even more profitable. And therein lies the farce that is the stock market. The market expects you to perform better quarter after quarter after quarter. All this while Motbot, or Claudebot, aka Motbot, is on its own social platforms now, doing like bot book or whatever the hell it's called, where they're talking about humans interacting with them. And right now, the early AGI-like bot that's not AGI, that's able to take care of some tasks, and yes, there's a whole narrative about security risks and stuff like that. That's out there. People are blowing their mind. They're buying Mac Minis, and they're starting to deploy this stuff, but they're using that as personal assistance. It can do stuff like tap into things, teach itself to speak. It can go out and get investment strategies and do a lot of things. And yes, there's a whole hell of a lot of problems. It's not perfect, but it's a good place to start. This is what everybody thought AI was going to be, okay? Now, if one of those Mac Minis for $600 and some infrastructure can have an AI bot in it that can work basically as a personal assistant plus 365, 7 days a week, 24 hours a day, then at some point in time, these companies are going to pivot to that over humans, and they're going to expect humans to be more efficient and more productive. Hey, you've got all these tools now. I expect more output from you. And the single greatest cost for a lot of companies is their FTE, their employee cost. So not all, but a lot. So I think this is going to affect the job market in a way that is materially disconnected. And I know that Warsh, the incoming FOMC chair, and a lot of other people feel that this will also create jobs because historically speaking, the internet created jobs, didn't destroy them despite the rhetoric. I think this one's different. And I think that we're already seeing early warning signs of it that we can't quantify as well. And we also have the problem with lagging data too. So, grain of salt. Let's keep going. I think you're going to like where we go next. So now we're going to talk a little bit about home prices. The San Francisco Fed came out and, well, this one's via Instagram. And I've had, full disclosure, I've had some issues with Instagram working in this social format. So if it looks a little weird, it's not me. It's Instagram changed the way they presented some stuff. Yeah, see? Not pretty, but don't worry. I got you. All right, there we go. This is Instagram, house prices and income 1975 to 2024. And I can't zoom in like I can on X, which kind of sucks. So why are homes so pricey? A new economic letter, link in bio, suggests that differences in affordability may reflect differences in housing demand rather than constraints on the housing supply. No. In other words, housing may simply reflect underlying labor market dynamics. I mean, really, we're gonna stretch. That's what we're doing now. We're gonna stretch and say like, oh, you know what? Housing's unaffordable, but it's because of the underlying labor dynamic market. No. Okay, look, houses cost a lot. Sure, central air, better technology. They're probably a little more expensive to build from a technology stack, but more efficient to build from an overall cost of products. But labor's more expensive now. So yeah, you can always, throughout history, there's always going to be a changing dynamic of how much things cost to build. Let San Francisco Federal Reserve Bank of San Francisco, shame on you. Shame on you. And yeah, you're going to make me go here, so I'm going to go here. Let's talk about this from another perspective, okay? U.S. homeowners equity at $36 trillion, okay? And this is one you want to perk your ears up to and listen on, okay? Because this one's going to tell you some stuff. Here we go, John Brooks. This is via X. Actually, let's start here in this view. U.S. home ownership equity is $36 trillion. Yikes, that's a lot. Almost 3 times the 2006 peak. Don't worry, I'm going to show you. Chart work coming. If you're not wondering why, sellers won't sell, buyers can't buy, transactions are dead. This is the reason, okay? So clearly this is a guy who thinks that house prices are too high. I agree with that. But I'm not going to sit here and tell you that this doom porn of something happening is real, because frankly, I don't know that it is real. And I don't know how you fix some of these problems that he's highlighting. And they are problems, and he is right. Let's take a look at the chart. This is household ownership equity in real estate. Now, we've got more equity in homes than ever before. This chart shows you that. There you go. All right, 2025. That's $36 trillion, kids. During the height of the real estate peak leading into the great financial crisis, we had $14 trillion in equity. Now, anybody who looks at this chart who's got any experience with synthetic mortgage-backed securities is going to say, okay, the equity, the prices weren't the problem. The problem was you had synthetic mortgage-backed securities with different degrees of risk being sold into the market, and as people defaulted on those and could not make their mortgage payments. This is a different problem. 60% of the population have a mortgage. Of that 60%, another 60% of them have mortgages below 5%. So making a payment is not the problem. Accessing this capital is a problem. Okay, so how are you going to access it? You going to sell your house? No, you're not going to do that. Okay, because why would you do that? Where are you going to buy? You're going to buy a super expensive home, so you're going to go, nah, I'll keep it. I like where I live. Then you go, okay, well, am I going to refinance my first mortgage? No, you're not. So where are mortgage lenders making the most amount of money right now? They're offering home equity lines of credit that are in second trust deed position. So if you got a first trust deed, they're going right behind that, because this way you get to keep your, so let me just, here, you know what? Let's draw some pictures. If you have a first trust deed at 3%, right? And you've now got all this equity appreciation. Your home value has gone nothing but up over time. You got all this extra equity, and let's say you want to go up higher, you can get a second trust deed with today's adjustable rate. Let's call it somewhere between 7 and 8%. And I don't know what home equity lines of credit rates are. And this is the biggest product on the market right now, kids. Home equity line of credit, tapping into that equity. This will increase payments, because guess what? Now you're paying this payment plus this payment, and this payment's generally variable. And because of that, you wind up in a situation where you can tap into your debt, but there's no motivation to buy or sell a property at this particular juncture. If you're a buyer, properties are still expensive. And if you're a seller, well, where are you going to go, right? So this is what the market lockout effect is, and that's what this is basically alluding to. There's a ton of equity. Now, is this comparable to the great financial crisis? Is this a problem? No, inherently it's not. Is it a bubble? Absolutely. Yeah, you can't. I mean, come on. Yeah. Yeah, that's a bubble, and that's real. That's going to be a problem. But again, what I say to everybody is, here's a housing bubble. You've also got an AI bubble, right? You got a housing bubble, AI bubble. What's the trigger? These are real bubbles. These are real. They're going to get corrected at some point in time. But after 14 years of artificial interest rate deflation, after this prolonged period of time where we've seen values increase, and this chart is not different, right? This looks like a narrow window of time, but really from this point to this point, that's 19 years, 20 years, okay? And really, when you think about it in the context of here, where market value started to come back, that's what, 2012-ish to 2025? Again, remember I said 14, 15 years of artificial interest rate deflation? This is what artificial interest rate deflation does to values, okay? This is what it does to home values. This is what this wild consumer spending can do. We talked about this on episode 320. If you want to understand why I think there's another wave of this coming before things break, and how we all got the bamboozle of a lifetime, tariffs were not what we thought they were. And on episode 320, dropping tomorrow, we're going to cover it in detail. And I'm going to explain to you how the greatest magic tricks of all time are the ones that are laid out so far in advance, you don't see them as magic tricks. They just look unbelievable. They look like miracles. Well, one of those was played out right in front of our eyes. Episode 320 covers it and explains why tariffs are going to cause this problem all over again. It wasn't an accident, and it's been played out in front of us solely to do exactly this all over again. What up, Lisa, my sister in the chat? I think you're on Instagram. I can't tell specifically. Let's jump into the next topic. The next topic is equally as sexy, and I think it's going to be one that you also like, because this is going to show you my animus, if you will, with Logan over at Housing Wire. Again, I have a tremendous amount of respect for Logan. This is not knocking him. He deals with people from anonymous accounts on X all day long, a lot of which are bots, and you know what? You don't really know what you don't know. So I'll say, actually, hold on, Sai, you got comments over here? Hold on. Oh, we got Sai. Look at Sai's in the chat, dropping some knowledge. Hold on a second. Let's go over here. What's going on? I'll take my eye off the ball for a second. So let's see here. We got Brandon. Sai, thanks, man. I'm so new to this, but have been doing nothing but trying to learn the current economy and the state of things, LOL, and how to try to protect what wealth I do have. We will help you do that, brother. Just tap in, listen, ask questions. We're here for you. We don't know everything, but we sure as hell will try our hardest to get you answers. And of course, Saeed responded back here, taking the initiative to learn is what it's all about, and we promise to deliver that to you to make better, more informed decisions. Some of this is just being around enough and listening to it. Yeah, enough here he went on. See, I think you're breaking up multiple comments. Enough conversations to begin to recognize the patterns. And Saeed and I are no different. If you had asked us 20 years ago about this stuff, we would have known. We kind of geeked out on it. We have a podcast which commits us to talking about this every single week for at least an hour or two at a time. Appreciate you too, brother. And because we have the podcast and we sit down and we make this effective focus, one of the things that we're sitting here doing is we spend at least an hour a week in a room talking about it, a couple hours a week, just kind of going over like what we see and exchanging stuff in group messages. And then I spend a disproportionate amount of time doing stuff like this with you guys, where we spend time looking at the markets. And now I'm incorporating other tools like AI, like X, like social narrative to feed us information. And one of the things that I think is really valuable from this that, I want people to take, I don't want to tell them that, but, I'll tell you straight up, my own perspective here is that there's a lot of people who are really intelligent in the market, have very sophisticated tools like this at their disposal, and they use them to make investment decisions. We're trying to democratize that. Shout out to Robinhood and Vlad and his team over there by giving you those same tools to make the same level of investment insights. We know you can't watch CNBC all day long. I used to watch it all day long in the office of the bank. We're trying to give you that in literally an hour. We want you to walk away from this hour-long dialogue 3 times a week feeling real confident about you knowing what is and is not happening in the markets, right? You're going to see headlines on CNBC. This is the year of the small cap, not the mega cap. And you're going to be like, what the fuck does that even mean? So we'll help you through the narratives. We'll try to make some sense to you. The problem with a lot of networks, Bloomberg, CNBC, all the networks talk about finance. They'll tell you either to do something or not to do something. They'll give you some numbers or some data, and they require you to understand. Like the VIX is a great example of it, right? They give you, the VIX is at 18 today, and you have no idea what that means, right? So we pull up the synthetic volatility index, and we tell you exactly what that means. We bring up some of these charts, like the outlook forecast model, and the model will literally tell you what it's looking at and why it's making decisions. So you don't have to figure stuff out. And everything we touch, and I'll give you a great example of this, like the market status here, Everything we touch is broken down into very simple narratives. That's the current market status, right? We're in a growth run. It's a healthy bull. It's feeding directly from this here. It's telling you red bad, green good. This leading that way tells you from a heat map chart. I mean, these are very idiosyncratic, simple things for us to understand. And then if we ever dive into things like sectors, keep an eye on this bar here, okay? We're going to go into the sectors real quick. And there you go. It's telling you the current status of the market on that main chart. And then you can look at the chart at the markets and say, okay, we're still in a growth run. Here's where the markets are. And you can tell exactly what's going on. So if you see something weird going on, like for example, we go over to the housing market and you can go, okay, but the market's still in a growth run. We're still in a healthy market. This sector is having a bit of a different status, right? Or you go to energy, which is going to be negative, right? Largely negative. And you can tell how this relates to the overall market by comparison. So we're trying to make things as visually engaging and as simple as possible. All right, let's go over and talk some trash on Logan, right? Okay, again, love Logan. Good dude. This is bullshit, all right? Absolute bullshit. Homeowners are doing fine. Fixed debt cost and rising wages, they're good. They're good. So let's unpack this a little bit, all right? Let me explain to you why that is misrepresentation, okay? Let's go to the big picture here. Let's take a look. All right, so what he's citing here is this chart from Housing Wire. Logan does work at Housing Wire. The majority of FICO score data from 15 years have been 720 and above. Okay, that's a fair statement. All of what he's saying here is factually accurate. I have no problem with the facts. He is accurate, okay? He's basically saying that homeowners have fixed expense costs. Let's go back to his actual quote so I don't misquote him here. Fixed debt cost and rising wages, they're good. Okay, that's what he's saying, all right? So again, that's true, right? They have good credit scores right now in this economy. Again, prosperous economy. We saw that in the previous chart. Everybody's got money to spend, and we're going to see another influx of that because of tariffs. Episode 320, go check it out. But tomorrow, 7 a.m. PST. Yes, he's right. And people got a ton of equity in their homes. They got good FICO scores. There's not a credit default. But Logan's also smart enough to know, and I understand he's fighting a bunch of trolls on social media who are probably not, that most recessions throughout history are not housing recessions. The great financial crisis where you saw all the synthetic debt issues, that was not this. No one is saying that's going to happen again. No one is saying we're going to see a housing recession. No one's going to see a market crash, 20% more change in values. But that being said, this is so goddamn tone deaf, it's unbelievable, okay? Yes. Okay, the majority of FICOs are healthy. Yes. It's very different than we saw during recessionary times. All true. But he's ignoring something, okay? Homeowners are doing fine, as he said here, okay? The problem is home affordability. People who cannot buy homes. Come on, Logan, be better than this, dude. You're completely ignoring the fact that a lot of your constituents are trying to get into a home, right? The average age of a home buyer is now 40 years old, right? That's wild. You're going to tell me people wait, they're 40 years old to buy their first home, but homeowners are doing fine, fixed debt costs. Yeah, homeowners are doing fine. So maybe he would, if he were here, he would argue that he's just trying to point out this note and he wasn't saying that homes aren't too expensive. But again, Housing Wire, a lot of realtors, a lot of mortgage loan officers, they make the money off the higher the home values are. So their solution to the affordability crisis is always rate. Now, again, playing devil's advocate, if I were to go back to something like the affordability index here, to his point, and I'm sure if he would argue it, a drop 1% in rates is much more meaningful to your payment and affordability than your drop in home value. So for every 1% in rates, you're approximately, call it 30%-ish in home value correction that would need to happen. So you can tell how one lever is much easier to pull than another lever. So again, I just don't think you should make comments like this and be completely tone deaf to what's happening in society when there's an entire class of the population who are struggling to buy a home for the first time. And his comment was, people don't care how much their expenses are relative to their homes is increasingly quite a take. Yeah, whatever. And here you go, comments. So we don't care about people who don't currently but would like to buy homes and start a family, I see. That was the same sentiment that I took from it. Just looking at the dollars in subprime mortgages from 2003 to 2007 tells a bigger part of that story. It's not the homeowner, it's not the it's the non-homeowners. Yeah, that's right. And then he says, housing demand is still positive even with epic snowstorm. And this is where I listen to Logan. As much as I like him, he's always factual. He's very accurate. I'm not disagreeing with him. Brother, you got to slant, man, and you got to be a little bit more even keel with a little bit of an appreciation. And I understand your job is Housing Wire. You have a lot of realtors and real estate professionals who work with you. That's fine. but you got to give them a little bit of the downside too. In that, look, like, okay, your homeowners can buy, but your non-homeowners up to the age of 40, which I don't want to be the bearer of bad news here, but as the aging demographic ages up, that population is going to want to buy homes, but that isn't going to be for a long time. And you're going to have a divide here that's got to get fixed. So I think the affordability crisis is a real problem, and I don't think that kind of narrative is appropriate or safe. So I said it. I said what I said. Let's take a bit of a spin here to Bitcoin. I know how much Saeed loves it. Well, Saeed, this one's for you, brother, because I know how much you have wet paper towel hands. Here we go. Bitcoin is down 40% from its peak last October, its biggest drawdown since 2022. BTC, showing you the changes there on this chart. I can pull it up, but let's just, you know what, let's not do that. Interesting fun factoid. Over the weekend, a lot of the Epstein files were released, and it is really devastating me. Peter Attia, probably top of that list. I love that dude. Still got a whole lot of respect for him. To find that he had a nexus to Epstein was wildly unexpected. I'm not going to comment it further on it than that, but I will say that I did spend some time reading all the files, and from a financial perspective. And the reason why I did that was because the emails that were released seem to suggest that Mr. Epstein knew 5 of the cryptocurrency Bitcoin founders. It's not Satoshi. He knew the developers. And according to the emails that I read, the communications that were largely redacted in parts, knew their first names, claimed he knew the current status of their foundation and where the money came from. I was expecting cryptocurrency to have a bigger hit in result of that. Now, keep in mind, this is a 24/7 market, so it wasn't trading hyper down any more than we're already seeing here. Some of this just could be the liquidity and the market's reaction, but very, very strange. I would say keep your eyes on crypto. For those of you who watched our episode where we talked about getting away from the traditional split of 60/40 stock, equities, and bonds, and we were telling you, hey, maybe look at the QQQ and some crypto, right? Like, so maybe some BTC. This could be a buying opportunity for a lot of people. I think it might be. But again, that whole Epstein thing, like, I don't feel comfortable investing until that plays out a little bit longer and we see if that narrative is going to be impactful. Now, a crypto bull were here. He or she would say something to the effect of, hey, man, look, there's too much institutional money. There's ETFs. There's too much money in it. And there's even mainstream adoption by your boy, Jamie Dimon, coming out here to some of these events talking about how amazing cryptocurrency is and the blockchain. This isn't going to do anything besides slow things down. And you know what? Great. I hope that's the case, because if it is, this is a great buying opportunity coming up. If Bitcoin's down 40% from its peak last October, for some people, this is an opportunity to buy now at a decent price before it goes up even further. So again, this is one of those things we're going to watch and spend some time on with the social narrative. And if I don't recall correctly, and I think that I do, that was one of the headline risks here. Market rally, global concerns, natural gas, India, Disney, market concentration, government shutdown, jobs report also on there. I'm going to refresh. Actually, no, hold on a second. Let's talk about this one here. Actually, you know, I wasn't going to do this on the show just yet, but you know what? We're here. Let's look at AI again one more time. All right, so I really got to figure out. Sorry. So one of the things is I don't have this programmed onto my actual hard button control yet, because I wanted to make sure everything worked first and kind of beta test it. So you're seeing me live beta test here. This trending now from an AI analysis today, pulled down with from X and Instagram. BLS announced that they won't release January jobs numbers report on Friday. As Saeed mentioned this at the start of the show, due to partial government shutdown, creating uncertainty around Fed policy. That is that. The market sentiment is about 40% mixed. It's coming from 8 trending topics from 85 posts that were tracked. AI's analysis here: missing jobs data creates Fed policy uncertainty. Expect increased volatility in rate sensitivity sectors until data releases. There you go. And we have a divided consensus as to what that means, which is also going to affect what this recommends, or there we go. That recommends as far as our modeling for future investment decisions. Really interesting to see how this plays out. I hope this continues to test well as we go through different variants of what this looks like. Really excited to see how this all plays out. I thought there was one about AI and cryptocurrency, but maybe I was just imagining that one in my head. So let's continue on with AI. Continue on with crypto. Let's go into The Fed balance sheet. This one is interesting, and I want to say that this is something we're going to talk a little bit more about than normal because I think there are some ramifications if this is true. I'll go into the social view here. I saw this last night on Mr. Crypto Whale, aka Saeed Omar. I hope Saeed's still in the comments. Are you still there, buddy? Oh, hey, Sean, look at you. Drop 50% of my BTC waiting in the sidelines till it works out. Yeah, I think that might be a good idea right now. That's probably what I would do if I was still holding BTC. I actually sold off mine a couple years ago because I'm. Site has wet paper towel hands. I probably have like wet torn hole rag hands. I think it's probably anyway. Not much better. The Fed is set to pump $14.3 billion into markets tomorrow, aka today, part of a massive $553 billion liquidity expansion program. I could not find any evidence of said program. Risk assets on watch. This could be strongly bullish for crypto and Bitcoin. Well, crypto and Bitcoin. Not according to what the price action we're seeing today is. So again, this is one of those examples, okay? Mr. Crypto Well says the Fed is doing these things, which is going to be massively beneficial, and I'm quoting, for crypto and Bitcoin. Yet, that is not what we're seeing. And of course, it's easy to take my word for it. And don't do that. Don't trust me. I'm a moron. I know that. We're going to go over to CNBC. I'm going to show you exactly where you can look at here. Go right over to crypto at the top of the bar here, and we can go to Bitcoin. And it's up a modest amount. Keep in mind, it was 100,000 before, so you're up about 1.72% in the last trade. So again, not super amazing, but not terrible either. Clearly, the market isn't like, oh my God, we know who the 5 developers are and freaking out because of the stuff that I freaked out over the weekend. So maybe the Fed stuff is true. Maybe it's not. I couldn't find any evidence of it. But then I log in this morning and I look at our chart here and I go, okay, wait a minute. If the Fed's pumping money in, because again, let's read the exact quote, because far be it from me to misquote somebody here. The exact quote was, the Fed is set to pump $14.3 billion into markets tomorrow at 9 a.m. Okay. Well, this is from a chart that I pulled this morning, tapping directly into the St. Louis Fed's data. This is vis-a-vis their API. And for those of you who saw my API key in the last show, everything's been refreshed, so sorry. Yeah, I had to. That sucks. Like, see, this is why I got to keep all my APIs in other places, but I'm trying to keep them off the AI because I don't trust AI because of all the rhetoric. But anyway. So yeah, if that were true, then I would say this is not indicative of it. As a matter of fact, the Fed balance sheet does not appear to be materially better. Now, 14.3 billion is not a massive amount of money for the Fed, even though it sounds like a lot of money. So I haven't seen this materially improve at all. So until such time as this improves and I see some type of benefit here, I don't know if that's going to happen. Now, I will say, if you listen to episode 320, and I keep pimping it on purpose because I want you guys to listen to episode 320, but if you listen to episode 320, I think there are events looming that, if they are to be believed and are true, and I have a good reason to believe that they will be and they are true, that you're going to wind up in a set of circumstances where you're going to see the crypto spike, not because of this, not because of the Fed balance sheet, but because of actions the government are taking that have a tariff derivative. Episode 320, halfway through, I get all sorts of grumpy and angry. I think it's worthwhile to break it down. But let me spend some time talking to you, okay? I'm going to talk at you, and then we'll address some of the comments here. And you know what? It's been a long time since I've done this. This is the chat. Look at that. Look at all the conversations going on here. Let me see what we got here. Sean, Saeed, Brandon, appreciate you guys. I wish I could bring the Instagram stuff in here, but Instagram doesn't have an API. This chat right here, there we go, is up in my platform here. And the reason why I prefer to view it on the platform is, number one, this looks a little gamerish to me. And number two, I can just click on one here and push it right over this way so we can all see it. So you guys don't have to like filter through and see where the comments are at any given time. But this is what it'll look like if I ever wanted to bring up the chat. I got mixed emotions about this. Let me know if you like it or not. I don't think that's a super good perspective. But when you got perspectives like this coming through, you just gotta share. You probably have more holes in your underwear than hands, my friend. Yeah, I actually do have a hole in my underwear today. I'm not gonna lie about that. I put on one of my older ones. Yeah, I got a hole. Anyway, that's a whole different conversation. But it's on the side. It's not the crotchal region for those of you who are wanting to know TMI. And shame on Pair of Thieves underwear. You know, they went all mainstream, started selling in Target, and they used to sell like this like longer boxer brief that was like 9 inches, which Daddy likes. Now they only sell like a longer boxer brief, which is 7 inches versus the standard 5 inches. And I'm a tall dude, and I don't like to feel like I'm wearing a thong, so I need the 9. You know what I mean? Aside, you clearly don't have this problem, but if you did, you can imagine it's not good. All right, so let's talk about the Fed for a little bit here and wrap the show up. Okay, a routine liquidity injection is supposed to support the banking system stability, right? Which is why the Fed announced this non-QE QE. And we're going to dump money in to support the tax requirements for most Americans leading up through April. So I don't know that posts like this on social media are valuable because that's kind of what was already told to us that was going to happen. Part of the Fed's ongoing balance sheet management, as we know, is part of this process because you listen to us during the FOMC lives. It's aimed at preventing overnight lending stress, not stimulating risk assets. So the overnight lending stress here they're talking about is banks borrow overnight from the Fed repo line, and then they use that money to deploy if they can, or they give it back. And the reason why, or they give it back as an option, is because they're usually borrowing at a number overnight, call it 3%, but they're earning 5% overnight. So they get a 2% arbitrage on the money. They're actually making money on the Fed repo line. And the Fed knows about this. The Federal Reserve ecosystem has actually encouraged banks to borrow from it overnight because they want to see them use it. So this is stigmatized as a bad thing. I've called a lot of people out on social media, particularly the TikTok influencers, that always talk about, oh my God, the Fed repo line's at an all-time high. It's going to blow up. And it's like, no, dude, this is just a smart financial play. If you're going to borrow overnight from the Fed, deploy that money into something, and then guess what? You're making money overnight on that borrowed money. This is just a normalized, smart financial vehicle, okay? It's over stigmatized a lot in the market. So I see stuff like this on X, and I'm like, really, bro? If I haven't heard about it, I don't know. So this is not quantitative easing. It's not a policy shift, and it's not money printing in the traditional sense. So what do you expect short term? Risk sentiment may improve, which we actually saw got a little worse in our synthetic volatility index. Liquidity helps calm funding fears. Bitcoin and crypto markets could see the bounce that this guy's talking about. But again, I think you're going to see that for other reasons. I think that's going to be clearly defined in episode 320. Equities may rally intraday, but follow through depends on broader flows. So again, that's also why you're seeing our AI analysis on things like the outcome forecast model suggest things. And I'll pull one up here just to have a little look at it for you. Let's go into outcome forecast model. Let's again look at Disney. Disney's had some intraday trading. I'm going to generate this real quick and pull this chart up for you. We'll go into the forecast and boom. So that's why you're seeing on this, because of the comment there about intraday trading, is you're seeing short trades being recommended versus long-term trades. There's just a lot of volatility that is likely to happen due to the cash position of the overall economy near term. So I think that's part of it. But if you want to look at the drivers of this decision, synthetic volatility index conditions still appear to be clear and calm. Disney's momentum, selling pressure, it missed those earnings today. It is a trending topic on social media, and we do have a liquidity pulse score draining. If there is any other stocks you want to take a look at vis-a-vis the outcome forecast model, or if there's anything else you want to look at, let me know. I can bring them all up here, and it automatically populates in real time. Otherwise, let's go to the comments. Oh, man, Powell. I don't know if you guys ever knew the guy. I think it's POA. He was a strongman in Ireland. He just passed away of a heart attack. I used to watch him all the time. He had a great social media presence, and he just died. It's hard, man, when you see people that are young, like, pass away, like influencers. And, I mean, he was a dad like me, too, so it's kind of nuts. My sister making a comment. We are seeing still people from higher priced areas pouring in for the affordability here, even though they aren't as affordable as they were. Yeah, okay. So, Lisa, to your point there, what do you think the state was with the highest amount of influx of residents in the country? South Carolina? No, North Carolina. Sorry. North Carolina was 12%, which is a massive population boom. So, yes, that trend is still happening where you're seeing people going from region to region to find more affordable housing. What up, Matt? Too long, brother. Way too long. I miss our Jeeps, your Jeep and mine. Anyway, GW, but that's a different conversation, different day. So, yeah, I think you're seeing that trend, Lisa, across the country still. I think you're going to always see that until such time as there's been a meaning and palpable home value correction, which I don't see a bubble happening. I don't see, if it were a bubble, how it's going to pop. I don't see any of those things being fixed. And again, 14 years artificial interest rate deflation. It's going to take 14 years-ish to fix, if not longer. I think it's just going to be a weighted out thing. So I don't know if there's any immediate, like, doom porn thing I can scare you with, because I don't think that's there. The scariest things to me are things that are going to make the situation worse near term, right? Unstable FOMC monetary policy. Warsh is an unknown quantity. Jerome Powell's still there. You got a president who has a divided opinion on the financial sector, largely because he's a businessman by trade. That's going to cause some headline risk for sure. You're going to wind up having some cryptocurrency changes. You're going to have some business and monetary changes, and you're going to have AI. So there's a lot that could be meaningfully impacting the markets in the near term. So let's to recap one last time before we wrap the show up. Let's take a look at the overall market status. Again, we aim to give you the entire day's worth of data in 1 hour, and let's wrap it up to make sure we all start at the same place. Market status is currently in a healthy growth run. It's a healthy bull market. We are outside of a tech led. This is actually just an overall market lift up today, and our synthetic volatility index, our version of the VIX, appears to be very calm. Again, continuing a slight incremental downward, but we're still well above normal here in the space of risk profile. So we have a healthy, normalized bull market growth run with very little risk. Fed liquidity is continuing to drain. We are at the restrictive end of the policy here, definitely in the draining side of the structure. Housing remains to be unaffordable. The data prints that we talked about are going to be delayed due to the government shutdown. So a lot of the stuff that you're seeing here that are public sector information, i.e. non-government sector, I should say, are going to be reporting. Stuff like JOLTS will likely come out, but a lot of the information that's government provided will not come out. So this is all TBD. And because there is the government shutdown, there is going to be some question as to what the overall health of the economy looks like. Diving lastly into sectors to wrap the show up. Let's go into just a couple of them. Geopolitical risk and supply risk seems to be high today. You're seeing the energy sectors and the commodities come down a little bit. Housing appears to be still stable and positive. Banking appears to be stable and positive. Even commercial real estate's having a relatively decent day, despite the fact that only American Tower is down. Mega caps are still positive. I checked. Nvidia down a little bit, largely because of the OpenAI debacle. And consumer spending at all the major retails, Walmart, Target, Costco, Home Depot, Dollar General, those are the outliers and the statistical like happy thoughts of the day. So if you want to say what's the winner on the day, that's who they are right there. All right, everybody. Unless there are any comments, questions, thoughts, concerns, anybody want to cuss at me in the comments, I'm always up for that. Now's your chance. Otherwise, I will see you guys all next time. Don't forget tomorrow, 7 a.m. PST, 3:20 comes out. We have a big revelation. We're going to drop some knowledge on you. It is worthwhile to check out if it does come true, and I do believe that it will. You're going to see a run-up in the cryptocurrency market. You're going to see a further run-up in housing, and we're going to explain to you all about why on episode 320. Until next time, if everybody else were here, they would look at me, I would look at them, we'd look deep into our orbits, and we would say, okay, bye!